Hi everybody and welcome to Finance with Ben. Today's topic is tax-free savings, or as their full name is, tax-free savings account. They're sometimes referred to as a tax-free investment, but in essence they're all the same thing. So what is a tax-free savings? Well, the government realized that us South Africans were not saving enough. So they thought to themselves, how can we encourage South Africans to save? They thought, what do South Africans hate doing? Obviously, paying tax. So they create an account where there's no tax payable inside of it. So this was introduced on the 1st of March 2015 to try and encourage us as South Africans to start saving and investing. So who's eligible? Any South African resident. You just need to have an ID and a proof of residence and you're able to open a tax-free savings account. This means even children can open a tax-free savings. Obviously, the parent or the guardian will just have to help with the FICA documents. And it's also important to remember, if you do any withdrawals from the tax-free savings, it has to go into the person who owns the tax-free savings account, bank account. So therefore, if you have a child's bank tax-free savings, it has to go into the child's bank account. How do the tax-free savings work? Well, as I've said, you don't pay any tax on a tax-free savings account. There's no income tax, no dividends tax, no capital gains tax, no tax at all inside of a tax-free savings. The only tax that becomes payable is on your death. Then this tax-free savings will form part of your estate and could be subject to estate duty tax. What can you invest in? There are a host of things that you can invest in. So I would recommend that you speak to a certified financial planner in helping you with what to invest in. And also just a point to remember is that if you go to a bank, for example, to open a tax-free savings, they're only able to offer you cash. So you can only get interest involved. If you would like to invest in something that's got equities or properties, you need to invest into a unit trust or into an ETF, then you'd have to go through a financial advisor. And that will be giving you potential for higher returns over the long run. So what are your limits? Because obviously, you don't want it's too good to be true, that everything is tax-free. There are certain limits that are applicable. So you're allowed to contribute 33,000 Rand per tax year. When it first came out in 2015, it was only 30,000, but it has increased to 33,000 Rand. And you're allowed to put up to 500,000 over your lifetime. It's really important to remember that any unused annual limit doesn't roll over to the next year. So for example, if you invested 27,000 in the first year, your unused portion of 6,000 doesn't roll over to year 2. In year 2, you can still only invest the 33,000 as your annual limit. Withdrawals. You can withdraw money out of your tax-free savings at any time. Most providers give you about a waiting period of 5 business days, and then that money appears in your bank account. A word of caution here is that if you, for example, you used up the 33,000 limit in your tax year, and then you withdraw 10,000 Rand, you can't then put in the 10,000 again. That's seen as additional. So you'd have to wait till the following year and then invest again. You've already used your 33,000. So withdrawals cannot be replaced. If you go over your annual limit, there are penalties, and that penalty is 40%. So if you put 35,000 Rand in, that exceeds the limit by 2,000 Rand, 40% will be charged on the 2,000 Rand, which means you get fined 800 Rand, and that'll be fined by SARS. Can you have more than one tax-free savings? Yes, you can, but you are limited to your annual limits. So the 33,000 per tax year and 500,000 over your lifetime. So for example, in 1 year, you could invest 11,000 into Old Mutual, 11,000 into Investec, and 11,000 into Absa. That's all fine because you haven't gone over the 33,000. So you can have more than one tax-free savings. From the 1st of March 2018, you're now allowed to do transfers. So maybe you had these three accounts in the previous example with Old Mutual, Investec, and ABSA. And now you thought, hey, why am I paying admin fees on so many different platforms? Maybe you want to have it all together. You can now transfer that into one. So you could put 11,000 from Investec and 11,000 from ABSA and put it into your Old Mutual and have 33,000 under your Old Mutual account. That doesn't affect your annual limit because that's a transfer. So you could still add the 33,000 from your annual limit. The power of compounding interest. Now, I've put this in here just to show you how powerful these tax-free savings can potentially be. So in this example, I've just assumed that you got 10% return and you've been paying 2,750 Rand every single month. Now that equates to the 33,000 that you're allowed per year. So let's have a look here. So at the end of year 1, you've put in 33,000. End of year 2, you put in 33,000. Now, obviously, it's going to increase because of interest. So if you look at the end of 15 years, you've put a total of 495,000. It's very close to the 500,000 annual limit. But the important thing is with the growth, you can now see you've got about 1.1 million Rand. So you physically only put in 500,000, but your tax-free savings has grown to 1.1 million. Now imagine you just leave it there for another 15 years. You're not allowed to contribute anymore because you've used up your lifetime limit of 500,000, but imagine you just leave it there to compound. So here you've got your 1.1 million that we've had from the last 15 years. We're not adding any more money to the pot. But you see now our 1.1 million after another 15 years has grown to 5.1 million. Now this has huge potential for us. You could use this. I've often suggested to clients to use this to supplement your pension money. If you're saving up for retirement, remember all the money that you get in your retirement is subject to income tax. So maybe instead of withdrawing 30,000 as a pension and getting taxed as if you're earning 30,000 Rand a month, why not only draw 20,000 Rand a month from your pension and then withdraw 10,000 from your tax-free savings? Then you're only going to get taxed on the 20,000. Or maybe in retirement you need to buy a new car, or you'd like to go away on some holidays. Tax-free savings, you can take that money out of that account, tax-free, and it gives you some disposable income. I think that's a really great way of using this tax-free savings, and you get the most benefit out of it because you've used compounding interest to give you the best benefit of not paying any tax. So I hope that clears up a little bit more about what a tax-free savings is. And if you have any questions, please reach out to me. You can find me on LinkedIn, or you can read some more on my blogs on my website, or even just pop me an email. And I'll gladly get hold of you and we can chat about it some more.